Ind AS 1 Presentation of Financial Statements. Ind AS 1 gives guidance for preparation and presentation of financial statements. Ind AS 1 applies to both separate financial statements and consolidated financial statements. However, Ind AS 1 is not applicable to interim financial statements. For interim financial statements, Ind AS 34 is applicable. If an NPO, non-profit organization like Section 8 company, apply this Ind AS 1 standard, they may need to amend the descriptions used for particular line items in the financial statements because Ind AS 1 generally these are applicable to profit-oriented companies. If non-profit oriented companies applies these standards, they need to change some descriptions. Next, in case of conflict between Companies Act and Ind AS, follow Companies Act. That means Companies Act prevails. In case of conflict between Schedule 3 and Ind AS prevails. Complete set of financial statements. Complete set of financial statements includes balance sheet, statement of P&L in two sections. First P&L, second OCI, third statement of changes in equity, fourth statement of cash flows, fifth notes to accounts comprising of accounting policies and other explanatory information, sixth comparative information in respect of the preceding period, seventh balance sheet at the beginning of the preceding period. That means opening balance sheet as on day one of the previous year. A balance sheet as at the beginning of the preceding period is to be prepared. That means opening balance sheet as on day one of the previous year is to be prepared only when an entity applies an accounting policy retrospectively or makes an retrospective restatement of items in its financial statements or when it reclassifies items in its financial statements. An entity is not required to present the related notes to the opening balance sheet as at the beginning of the preceding period. That means notes to accounts is not required regarding opening balance sheet as on day one of the previous year. Reports and statements presented outside financial statements, generally in annual reports, such as financial reviews by management, environmental reports, and value added statements, are outside the scope of Ind AS. So for these financial review statements by management, environmental reports, and value-added statements, Ind AS are not applicable. First, next balance sheet. Balance sheet is to be prepared as per Schedule 3 of Companies Act 2013. An entity shall present current assets, current liabilities, non-current assets, non-current liabilities as separate classifications in its balance sheet. Current assets. An asset will be classified as current only when any of the four conditions are satisfied. Any. That means R. First one, it is expected to be realized or intended to be used or consumed in normal operating cycle, or it is expected to be realized within 12 months after the reporting period. Reporting period means balance sheet date period, or it is held for trading in ordinary course of business, or it is cash and cash equivalents as per Ind AS 7, unless it is restricted of being exchanged or used for settlement for at least 12 months from reporting date. What do you mean by normal operating cycle? What is meant by operating cycle? Operating cycle is the time between acquisition of assets for processing and their realization in cash and cash equivalents. When the entity's normal operating cycle is not clearly identifiable, it is assumed to be 12 months. Therefore, if normal operating cycle is not identifiable, it will be 12 months. So, if an asset satisfies any of the four conditions, it will be considered as current assets. Otherwise, it will be considered as non-current asset. Next, what is a current liability? Current liability. A liability will be classified as current liability if it satisfies any of the four conditions. First one, it is expected to be settled in normal operating cycle, or it is due to be settled in 12 months after the reporting period, or it is held for trading in ordinary course of business, or it does not have any unconditional right to defer settlement of liability for at least 12 months after the reporting period. If any of the four conditions are satisfied, it will be considered as a current liability. If no condition is satisfied, it will be considered as non-current liability. Next, examples of some important current liabilities and current assets. Security deposit received is generally a liability. If it is cancelable, that means security deposit cancelable, it is a current liability. Next, capital advance given for purchase of machinery. It is a non-current asset. Next, sale of machinery, which is receivable. That means sale amount is receivable. It is a current asset. Next, electricity deposit paid. It is a long-term deposit. It will be long-term in nature, so it is a non-current liability, non-current asset. Electricity deposit is non-current asset. Next, tender or earnest money deposit paid. It is either a current asset or non-current asset depending upon the circumstances. Next, GST deposit paid under dispute. It is either a current asset or non-current asset depending upon the circumstances. Therefore, tender, EMD, GST deposit paid will depend upon the circumstances to be classified as current asset or non-current asset. Next, breach of long-term loan arrangement. This is a carve out to International Accounting Standard 1. There is a long-term loan arrangement. Some conditions pertaining to long-term loan arrangement has not been fulfilled. In such a case, there is a breach of long-term loan arrangement. If there is a breach of non-current long-term loan arrangement before balance sheet date and grace period to rectify the breach is provided by the lender, then we need to check the grace period. If grace period is less than 12 months from the end of the reporting period, it shall be classified as current liability. If the grace period is greater than equals to 12 months from the end of the reporting period, it will be classified as non-current liability. If the company gets the compliance date extended before the breach, then such loan will retain its original classification. That is, it will be classified as non-current even if such extended period is less than 12 months from the end of the reporting period. That means before occurrence of the breach, if compliance date is extended, that means no default, it will be considered as non-current liability only. Also, if the lender agreed after the reporting period and before the approval of the financial statements not to demand payment as a consequence of the breach, then such a loan will retain its original classification. That means it will be considered as non-current liability only. Next, statement of P&L. Statement of P&L should be prepared as per Schedule 3 of Companies Act 2013. Statement of P&L has two sections: profit or loss for the period, other comprehensive income for the period. The sum of above, profit and loss plus other comprehensive income, gives total comprehensive income. When an entity is required to prepare CFS, consolidated financial statements, it shall present profit or loss for the period attributable to non-controlling interest and owners of the parent separately, total comprehensive income for the period attributable to non-controlling interest and owners of the parent separately. Next, statement of changes in equity. Statement of changes in equity shall reconcile between opening amount and closing amount for each component of equity by separately disclosing changes resulting from profit or loss, each item of other comprehensive income, effect of retrospective application or retrospective restatement recognized in accordance with Ind AS 8, transactions with owners in their capacity as owners, showing separately contributions by and distributions to the owners, and any item recognized directly in equity, such as amount recognized directly in equity as capital reserve as per Ind AS 103. Next, statement of cash flows. It was prepared in accordance with Ind AS 7. Next, notes to accounts. The notes shall disclose statement of compliance with Ind AS, information about the basis of preparation of financial statements, and significant accounting policies applied, supporting information for items presented in balance sheet, P&L, statement of changes in equity, and cash flows in the order in which statement and each line item is presented. In which each statement and each line item is presented. Next, other disclosure requirements as required by Ind AS will be presented in notes to accounts. Next, what are the general features of financial statements? General features of financial statements: presentation of true and fair view and compliance with Ind AS, going concern, accrual basis of accounting, materiality and aggregation, offsetting, consistency, frequency of reporting, comparative information. First one, presentation of true and fair view and compliance with Ind AS. In virtually all circumstances, presentation of true and fair view is achieved by compliance with applicable Ind AS. An entity whose financial statements comply with Ind AS shall make an explicit and unreserved statement of such compliance in the notes to accounts. An entity cannot rectify inappropriate accounting policy just by disclosing it. That is, disclosure is not a remedy for wrong accounting. There may be disagreement of company with the auditor on applicability of any Ind AS or particular requirement of any Ind AS, and accordingly, auditor may qualify the audit report. Even in such a situation, the financial statements will be assumed to be Ind AS compliant. That means even if auditor has qualified his report, financial statements will be assumed to be prepared as per Ind AS only. Next, departure from requirements of an Ind AS, whether permissible. Whether departure is permissible from Ind AS. In extremely rare circumstances, the entity may have to depart from the requirements of Ind AS because it would conflict with the objective of financial statements set out in framework. Then we need to check whether relevant regulatory framework does not prohibit such a departure, whether regulatory framework permits it or not. Ind AS permits such a departure, and it shall disclose that financial statement give a true and fair view as per management conclusion that complied with all Ind AS except the departure, title of Ind AS departure, nature and reason for departure and treatment adopted, financial effect of departure on the periods presented. Next, a relevant regulatory framework prohibits such a departure. Ind AS does not permit such a departure, but to reduce the perceived misleading aspects of compliance, it can disclose the following: title of Ind AS in question, nature and reason why management thinks that complying with the requirement is in conflict with the objective of financial statements, financial effect that would be necessary on all periods presented if the entity had departed. Next, going concern. Financial statements should be prepared on going concern basis unless management either intends to liquidate or to cease trading or has no realistic alternative but to do so. If financial statements are not prepared on a going concern basis, disclose the basis of preparation of financial statements and also the reason why the entity is not regarded as going concern. If management has significant doubt of the entity's ability to continue as a going concern, the uncertainties should be disclosed. Next, accrual basis of accounting. An entity shall prepare its financial statements using the accrual basis of accounting, except for cash flow information. Generally, cash flows are prepared on cash basis. Next, materiality and aggregation. Generally, immaterial items should be disclosed separately as per law. Information is considered as material if omitting, misstating, or obscuring it could reasonably be expected to influence decision of the users. Materiality depends upon the nature or magnitude of information or both. An entity assesses whether information, either individually or in combination with other information, is material in the context of its financial statements taken as a whole. An entity shall present separately each material class of similar items. Items of dissimilar nature or function, unless they are immaterial, except when required by law, should be separately disclosed. That is, even if items are immaterial, they shall be presented separately when it is required by law. Next, offsetting. An entity shall not offset assets and liabilities or income and expenses unless required or permitted by an Ind AS. An entity presents on a net basis gains and losses arising from a group of similar transactions. For example, foreign exchange gains and losses or gains and losses arising on financial instruments held for trading will be presented on net basis because it was permitted as per particular Ind AS. However, an entity presents such gains and losses separately if they are material. Next, measuring assets net of valuation allowances is not offsetting. Example, obsolescence allowances on inventories and doubtful debts allowance on receivables, their presentation is not considered as offsetting. Next, consistency. An entity shall retain the presentation and classification of items in the financial statements from one period to the next unless another presentation or classification would be more appropriate or an Ind AS requires a change in presentation. When making such changes in presentation, an entity reclassifies its comparative amounts unless reclassification is impracticable. When the entity reclassifies comparative amounts, disclose nature, amount, reason for the reclassification. When it is impracticable to reclassify comparative amounts, disclose the reason for not reclassifying the amount and the nature of adjustments that would have been made if the amounts have been reclassified. Next, frequency of reporting. An entity shall present a complete set of financial statements, including comparative information, at least annually. When an entity changes the end of its reporting period and present financial statements for a period longer or shorter than 1 year, an entity shall disclose a reason for using a longer or shorter period and the fact that amount presents in the financial statements are not entirely comparable. Next, comparative information. Minimum comparative information. An entity shall present comparative information in respect of the preceding period for all amounts reported in the current period's financial statements. Comparative information for narrative and descriptive information presented in notes should be included if it is relevant to understand the current period's financial statements. That is, minimum two balance sheets should be given, two P&L accounts, two statement of cash flows, two statements of changes in equity, and related notes should be presented. When an entity applies an accounting policy retrospectively or makes a retrospective restatement, it shall present minimum three balance sheets. That is, at the end of the current period, and at the end of the previous period, and at the beginning of the earliest comparative period. Two of each of the other statements and related notes. Additional comparative information. An entity may present comparative information for more than 1 year. The entity can also give comparative information of more than 1 year for statement of P&L and only 1 year comparative for other statement of financial statements or vice versa. Rectification of breach or waiver of breach of long-term loan arrangement after balance sheet date. This is a carve out from International Accounting Standards 1. This will be dealt as per Ind AS 10, events after reporting period.